Thank you everyone for joining us to learn more about research and development tax credits for the aerospace and defense industry. As a quick reminder, the material appearing in this presentation is for informational purposes only and should not be construed as advice of any kind, including, without limitation, legal, accounting, or investment advice. This information is not intended to create, and receipt does not constitute a legal relationship, including, but not limited to, an accountant-client relationship. Although this information may have been prepared by professionals, it should not be used as a substitute for professional services. If legal, accounting, investment, or other professional advice is required, the services of a professional should be sought. All right, so presenting today will be myself and Star Fischer. My name is Peter Henderson. I'm a senior manager in the R&D Tax Credit practice here at Moss Adams, and I'm heavily involved with our aerospace and defense industry group. Star?
This is Star Fischer. I'm a partner and work with Peter in the R&D Tax Services group and have been working with clients claiming the R&D credits in the aerospace industry for the past 19 years. In this brief webcast, we'll be covering the following topics: a brief overview of the qualifications for the R&D credit, discuss the top issues related to claiming the R&D credit in the aerospace industry, and a high-level overview of the different aerospace subsectors where R&D credits are claimed.
And it's important to note that this credit is especially relevant for aerospace and defense companies right now, given the current status of the industry, and the fact that this credit is a cash flow opportunity. The reason why we think it's really relevant now is that this COVID pandemic started in January of 2020. And since then, it's had a very significant negative effect on aerospace companies. Prior to this starting, aerospace companies were doing very well in general. So many companies are looking at a large tax bill for 2019. So this is a way to potentially offset that. Moving into a general overview of the R&D tax credit. And we're talking about federal credits mainly, but various states have state credits. Generally, they follow the federal credit in terms of rules. In terms of states that have state credits in the Western U.S., the ones with a lot of aerospace activity are going to be California, Arizona, and Texas. So the R&D credit is an expense-driven credit, and there's three categories of expenditures that can qualify. First and foremost are wage costs, and these are expenses paid to employees. Next is supply costs. This is generally limited to consumable supplies, but there are some exceptions to that. And then the third category is contractor costs. So this is anytime you're paying a third party to perform activities that would otherwise qualify in-house by employees. Now the credits, the actual credit amounts generally will equate to between 6 to 14% of your qualified development costs. The 14% figure is going to represent credit claims where a state credit is also in play. But the reason that there's a variable rate to this, in addition to certain states having credits and certain states not having credits, is that the credit is to an extent is designed to incentivize increases in development year over year. It doesn't mean that you have to be increasing your spend to get a credit. It just means that if your spend's trending up, you're going to have a higher return on your qualified costs compared to if it's flat or if it's decreasing. So in terms of what actually qualifies, there's a four-part test that activities must meet in order for the expenditures associated with those activities to qualify. The first one is the most straightforward, and it is that the activities need to be technological in nature. This means that they rely on hard sciences, whether it be physics, various types of engineering, even computer science is considered a hard science. The next one is one of the more relevant ones for aerospace, and this requirement is that the activities need to be intended to develop a new or improved product or process. So the key words there are new or improved, as well as product or process. We'll talk about that a little bit later. Third requirement is that there needs to be technical uncertainty in the development, basically meaning that you can't know exactly how you're going to get to your end result from a technical perspective from the onset of the development project. And then finally, there has to be a process of experimentation, which means that you need to evaluate different design alternatives in order to try to eliminate that technical uncertainty. So next up, we're talking about top issues for the aerospace industry.
The number one top issue and consideration for aerospace companies claiming the credit is funded research. In order for a company to claim credit for an R&D activity, they must have both risk and rights in the research performed. The majority of credits claimed relate to work performed under a customer contract. As such, it is important to review the contracts to ensure that it does not prevent you from claiming the credit related to such work performed. Generally, fixed bid or lump sum contracts related to delivery of a completed product, part, or tooling will be credit eligible.
The next top issue is the concept of project nexus. And this kind of goes hand in hand with the third bullet there, which relates to job cost data. The idea with project nexus is that in claiming these credits, we're required to show the qualified expenditures by what the IRS calls business component. And that's kind of loosely described as a project. The reason that this requirement exists is that when these things are audited, auditors are first going to want to see qualified expenditures by project, and then they're also going to want to see support for certain projects. That could be a sample of projects, that could be the top however many largest projects. But the idea is that once that support is provided and then reviewed, if they determine that any projects do not qualify, they then have a mechanism and a way to remove the qualified expenditures associated with those projects and adjust a credit accordingly. If that project nexus didn't exist, then there would be really no way to audit the credit. So one of the ways that we commonly get project nexus for aerospace and especially defense contractors is through the use of job cost or project tracking data, since it directly ties expenditures to the specific projects and oftentimes activities that they were incurred on. So whenever we do have job cost data or project tracking data, we almost always use it. And a lot of thought goes into the most effective way to use job cost data for a particular client. All companies have different types of job cost data, different information. So how to properly leverage that is a key consideration. It's also important to note that if a company doesn't have job cost or project tracking data, we can still claim the credit. It's not a requirement. There's other ways to get that nexus. But in the event that it does exist, we always try to use it.
As Peter covered, a significant effort is put into supporting the quantitative aspect of the credit calculation. Another aspect to the credit is qualitative support. And this involves supporting that the project, activity, and individual is performing qualified research. And this, like Nexus, can be done, the support for this can be done in multiple ways. It tends to be through interviews with key personnel who worked on the R&D project, review of underlying design revision documents, emails, notes, or whatever is available to support that each activity or project qualifies for the credit.
Right, so now we're going to move into talking about some specific considerations on a subsector level. So starting off with original equipment manufacturers or OEMs, and from an aerospace perspective, when we say OEMs, we're generally talking about the airframe manufacturers or also the engine manufacturers and designers. So that's going to be the large companies, the Boeings, the Airbus, potentially Lockheed, depending on the project, as well as companies like GE or Rolls-Royce. Now, we're not going to spend a lot of time on OEMs because it's, for the most part, it's probably one of the more straightforward categories. The reason being is there's generally no question as to whether those OEMs are going to have economic risk and IP rights in relation to the programs. One example of that is Boeing with the 737 MAX. It's very clear that Boeing has economic risk as far as that program goes, and we've seen that economic risk play out in recent months.
The second category is subsystem designers and manufacturing. This category would include aviation subsystems such as audio, visual, electrical, and mechanical components. The qualified activities here are typically the design or substantial modification of subsystems, includes engineering time, as well as individuals who are prototyping, the prototype costs themselves, and also first article production runs.
All right, so next up, machine shops. And this is an area or a subsector where we see a lot of R&D credits go missed. The reason that there's a significant opportunity here relates to the second of the four requirements, the four-part test, which is that the activities need to be intended to develop a new or improved product or process. So manufacturing process development can also qualify. And so even for, say, build-to-print machine shops, where they don't have any input into the design of the actual parts being built, they do have input and they are responsible for the design of that manufactured process. And with how complex aircraft are and all the various subsystems and the associated parts are, those manufacturing processes can be very complex and require a lot of design and development time. So it's not only the initial design and development time, but all that sequencing and resequencing of those manufacturing steps and operations in order to get that part not only built correctly, but in an efficient and optimized way.
The next category is maintenance, repair, and overhaul for MRO companies. Although maintenance activities are generally not included in the credit calculation, substantial overhauls or repairs can be. This typically may include a conversion from a commercial aircraft to private, repairs requiring a new part due to FAA changing regulations, PMA parts, or any activities requiring new designs or modeling. And the other bucket can cover a lot of different areas, but most commonly would be tooling designers, design houses, engineering firms, or really any company that is investing resources into new product or new process development.
All right, well, thanks everyone for your time today, and we hope you found this discussion informative. To learn more about specific research and development credits available to your aerospace and defense sector, your specific subsector, including, machine shops and all the ones we mentioned, please see the webinars linked on this page for a deeper dive. And if you have any questions in the meantime, please feel free to reach out to Star or myself directly, and we've provided our contact information here. Thanks, everyone.